Hi, my name is Elal Kalai, and I'm very honored to be here with you and Simpson from the Managing Investment Director and Board of Governance and Sustainability with CalPERS since 2009, I think you said. So that's a long time to be with the largest pension fund in the US. Is that correct?
Yes, I've had several roles at CalPERS, but yes, I joined just after the last but one financial crisis. Joined CalPERS from London, yeah.
And so really, the focus of our conversation is on ESG. And so I think the first question is if you could define the essence of CalPERS ESG strategy in a few sentences for our audience.
No, thank you very much. And we're very honored to be joining you for this discussion. Thank you for including us. CalPERS thinks of ESG as sustainable investment. We haven't really used those three letters because there's a letter missing for an investor, which is the letter F for finance. So if you just think about ESG as a topic on its own, you then have got the dilemma of how do we integrate this into all of our investment decision making? So the approach that CalPERS has taken is a little bit different. What we did some years back was really think about the long-term sources of value creation for our portfolio and also the risks that we face. And just to set the scene, as you said, CalPERS is the largest public pension fund in the United States. We have assets of around $430 billion to invest. So both in terms of systemic risk, for example, issues like climate change, we have nowhere to hide. We're what might be thought of as a universal owner. We have a little piece of everything in the portfolio. So when we're looking at sustainability issues, we're really thinking about the long-term value creation for our pension fund members. And that's very important because for every dollar that we pay out in pensions, 55 cents comes from investment returns. It's the largest source of contribution to people's pensions. So it's extremely important that we think about the sustainability of our fund from a financial point of view. So the way that we frame the sustainability agenda at CalPERS is to say, we believe there are three forms of capital, not one. So financial capital, yes, that's the traditional day job of an investor, deploying financial capital. But in our investment beliefs, we say, in order to create that long-term value, we have to understand that stewardship of human capital and natural capital are part of what makes long-term value creation possible. So it's this model of the three forms of capital that has underpinned our strategy on sustainable investment. Now, if you actually think about value creation in that way, then you begin to pay attention not just to what's happening, say, on the G, the governance of your financial assets, but you also think about the people, the workers, the communities, that's the human capital that are going to be important to and affected by what a company does. And in terms of natural capital, we're not just thinking of climate change, but there's a wide range of other issues that are important as well, which are directly and indirectly linked to that concern, biodiversity, water resource management, and so forth. So that is the underlying foundation. And on the back of that, we built a strategic plan to integrate that thinking right across our portfolio.
So I'd like to ask you a few questions regarding those specifics. And so one question would be really about the environment, because it seems that we have this incredible opportunity because renewable energy has become basically cheaper than fossil fuels, so the finance makes a lot of sense. But not only that, but Europe and China, and hopefully now the US as well, are going to invest huge amounts of money in renewable energy and removal of fossil fuel. So do you see a huge opportunity here? What would you advise investors to do in this environment?
Yes, you've put it very well. Often when we're talking about climate change, we're thinking about the risk that climate change poses. And we recently produced a very detailed and thorough analysis of the impact of climate change on our portfolio, in line with the recommendations of the TCFD, the Task Force on Climate-Related Financial Disclosure. So we've looked at all of the exposure of our portfolio to risk due to climate change, but also in that report, we were able to identify the opportunities. And you'll see that particularly in our private asset classes, that's private equity, real assets and infrastructure, we've nearly 20% of all our investments are now in what gets called climate solutions, renewables, sustainably certified buildings, water storage, energy efficiency, and so forth. So that, that's heading to the $15 billion mark in terms of an allocation. And that's happened because in our strategic plan on sustainable investment, one of the elements was to have each of our asset classes developing what we've called sustainable investment practice guidelines. You can find all these on our website if you're interested, which identify which issues in sustainability need to be integrated into investment decision making, and then to identify the sources of data, the approach, and so forth. What we've found with that progression, if you like, we would see it as a better informed analysis on risk and opportunity when you start thinking about financial capital, human capital, natural capital. With that framework, we found that our asset classes have started to deploy these significant sums of money into climate solutions. Now, you also see within big companies, let's take a company like Shell, for example, that's a company which we've been engaging through an initiative called Climate Action 100 Plus. And of course, Shell and the other big oil and fossil fuel energy producers, in making their own commitments to a transition to net zero, are also moving investments into renewables, into carbon capture, sequestration and storage, and intermediate stages along the way to decarbonize the energy supply in the global economy. So you'll find these opportunities in all asset classes.
Are there specific examples you can give to your activism through Climate Action 100 Plus?
Yes, thank you. That's a very good question. Climate Action 100 Plus is an initiative which has its origins in some work that CalPERS did a few years ago. My colleague Divya Mankikar had the formidable task of building out our first carbon footprint for our global equity portfolio, where we have about 10,000 holdings. It's huge. The analysis that she did showed that less than 100 companies were responsible for the vast majority of emissions. I mean, who knew out of 10,000 that 100 could be so important? So it was that insight that made us realize that for investors to really have a big impact bringing down emissions, they could and should focus on what we call these systemically important carbon emitters and make sure that these companies bring their emissions down in line with the Paris Climate Agreement. So just to give you a sense of the scale, we all know that the largest source of emissions globally comes from China, and the second largest source of emissions comes from the United States. If you thought about these 100 companies as a country, they would be the third source of emissions, just on scopes 1 and 2. So that we're not going for the low-hanging fruit here. These are the hardest to abate sectors and the biggest producers of emissions, and also provide a huge amount of the energy upon which the global economy relies. So the transition is a really important strategic issue for them. We're up to the stage now where around 50, about 50 of those companies have now made commitments to transition to net zero 2050. And that includes companies like Shell, like BP, big oil companies, also one of the largest cement companies in the world, the largest steel companies, shipping, aviation, transport, and more. And these commitments are coming not just from North America and Europe, but also in Asia. So why is that possible? Basically, because Climate Action 100 Plus now has $52 trillion in its signatory base. So this is, we launched only a couple of years ago, but I think it shows that there's this real concern and commitment in the financial community to make sure that we're deploying our finance in ways to meet our fiduciary objectives, to meet our returns, to manage risk, but also that we have this opportunity as the owners of these big emitting assets to actually work in partnership with these companies to get a strategy that's going to bring the emissions down to the net zero by 2050. So yeah, it's a lot more to do, but we're off to a flying start for sure.
Okay, so I have to ask you a little bit also about the social, because it is, given COVID and everything else, probably that's where the public focus is currently on. So what would you say would be really the most important part of your work regarding the social component of ESG?
Yeah, no, thank you. I mean, the way we think about the S in ESG in our three forms of capital model is this is the stewardship of human capital. So we have several tracks in our strategy. One is one we've just been talking about, which is engaging companies. So we've been engaging companies over the last several years under the strategic plan on issues of diversity on corporate boards. And I think in recent years, we voted against something like 900 directors because companies have not been in the United States willing to engage and make progress on those issues. So we're using the engagement track to bring about change in the company's leadership where we're owners. We also have another track across all of this plan, which is advocacy. And this is where we know that regulation policy is vitally important to providing investors, the level playing field. So, for example, on climate change, we want to see carbon pricing brought in. The cross-cutting theme for us is corporate reporting. And in the United States, we've worked closely at the SEC, the financial markets regulator, to propose a framework for what we call human capital management. And this was actually put forward before the COVID pandemic broke out, but it covers issues like the status of the workforce employment, how many people are employed, under what terms and conditions, and so forth, but also health and safety, benefits like paid sick leave, which are so important in a situation like this, diversity on dimensions of both race and gender. Again, a very important issue which has been raised in the United States and elsewhere with the acknowledgement of racial injustice across many economies, and particularly here in the United States. And we also have policies at asset class level which address these issues. So one example for our real assets program is we have a responsible contractor policy. And what that means is all of our managers owning and maintaining buildings where we are the majority owner report in through a very detailed template on everything going on with the workforce, so that we actually are able to monitor and gather data on these things. And this year, we just reported to our board there was 100% compliance with that program. That's been extremely important for ensuring worker health and safety, for janitors, cleaners, maintenance workers in our buildings, as well as during the building process when at times that comes forward. So there are many ways in which investors can have a very positive impact on human capital management and make sure that it's additive to the returns that we need, as a pension fund.
So, yeah, that's undoubtedly a pretty important aspect that's important also for Israeli investors. But I wanted to ask you specifically about gender focused ETFs, because there are now several of those on the market. Are you familiar with them? Do you screen them? Do you have any specific recommendations between them?
Yeah, no, we are aware of some of the new products that have been designed on particular themes, like ETFs, as you mentioned. and also new indices, for index construction around particular elements of sustainable investment. Gender's one, climate change, low carbon, and so forth is another. CalPERS doesn't use these instruments, partly because we invest internally. 80% of our money is internally invested, and we're just too big to start loading money into things like those instruments. They have a different audience to us.
Okay, so, but you don't use the indexes either? I mean, you obviously don't use the ETFs, but you don't use the indexes as guidelines or pointers?
We have an index for our global equity portfolio, which is about, that asset class is about half of our fund. So, a $200 billion or more index. But that is tailored for us because of our size, and also because CalPERS has some particular constraints on the portfolio. For example, we don't invest in tobacco, assault weapons for personal use. There is such a thing, amazingly. The manufacture of assault weapons for personal use, and some other considerations as well. So we have a FTSE all world all cap index, but it's been tailored for CalPERS. So we don't typically go and buy off the peg solutions. We have to have things that are designed for our particular asset allocation needs. Our asset liability modeling sends us in that direction.
So, given your size, I'm not sure that you can have specific recommendations for Israeli investors. We're a small country, but still, within this world of ESG investment, and given your incredible experience, do you have any specific recommendations for investors that are now entering this world?
Well, I think CalPERS experience is one that we can share, with other investors, however large or small. Maybe not for personal investors with their portfolios, but for institutions. I think the critical thing was that the process led us to a strategic plan that met our needs. So we started off with a research phase, and all of this material is on our website, so you can go and look at it. But we wanted to better understand which issues, in our ambition to be a sustainable investor, which issues were the ones that mattered most for an investor of our size, with our time horizon, with our liabilities, and so forth. And remember, depending on which investor you are, that will look a bit different. So you first of all have to understand your own fiduciary duty and your own investment objectives. Then we did a research review on something called the Sustainable Investment Research Initiative. In fact, we've just issued the third phase of that to look specifically at the impact of climate change on capital allocation, which will lead us to consider some of the new indexing and other instruments that are around, and see if they do fit our scale and our needs. We've also issued a call for research in this third round on human capital management, so that we can look more deeply at questions of health and safety, of racial equity, and so forth. The second part of our process, having done the research based on our own, looking at our own investment needs, was then to pick a limited number of priorities, strategic initiatives where we had evidence, we had conviction that these issues mattered to risk and return for our fund. And then we put a 5-year plan in place with a timeline, with performance goals and targets. And we said, there's 3 things we can do. We can engage companies, we can integrate into our investment decisions, and we can be advocates with regulators and policymakers. And so for the 6 issues that we identified, we worked out our strategy under each of those channels. And we said, in all of this work, even though CalPERS is big, everything we do, we work in partnership with others. And, so groups like the PRI, the Principles for Responsible Investment, that's a wonderful community for investors of all sizes from all parts of the world who can actually come and join in a partnership with others to learn more about these topics and get practical advice, as well as insight into how to go about developing a strategy. So our strategic issues are climate change, diversity and inclusion, data and corporate reporting, research, we just mentioned that, the project to ensure that all of our asset classes from the bottom up developed their own expectations to integrate. And then finally, we had a particular project on private equity where we were working with the industry to get better transparency on fees and performance and carry, which at the, when we started this work, it was a little difficult to find out what the information there we needed. So that's the critical thing, I think. Do your research, be clear on your own objectives, have some priorities, don't try and boil the ocean, as the Americans like to say, and give yourself targets so that you can measure your progress and make sure that this is going to really help you with your fiduciary duty, with your investment objectives on behalf of others.
So unfortunately, I think we ran out of time, but the success of your fund, and given the time that you've worked there, so your success is a pretty good indicator that people should listen to this advice. So I want to thank you very much for sharing this with us, and hope once COVID is gone, we can meet in person.
I would absolutely love that. And thank you so much for inviting me to join you. It's just a great pleasure. Thank you.